Welcome everybody to the third edition of the CEPR RPN International Lending webinar. My name is Christopher Trevish. I'm organizing the seminar, and it's a wonderful opportunity and great honor to welcome Ricardo Reis to this session of the webinar. Ricardo is one of the leading macroeconomists internationally. He has published very widely. He's one of the leading people on the current inflation debate, has received a wide range of prizes. He holds a PhD from Harvard, is currently at the London School of Economics. Great to have you back in Europe. There is a lot in his CV. I was a bit depressed to see that he's just 1 year older than me, given the CV. Very impressive, wonderful work. And this is a great paper that I know already, that I think is possibly the best paper out there on the rise of the RMB in the international system. So it's great to have you here. It's great to have you present this paper with Saleem Bahaj. And looking forward to seeing it. The floor is yours, and you'll have about 45 minutes, and we have Q&A.
Fantastic. No, thank you so much. It's a pleasure to be here. Let me just confirm, if you don't mind, that you can hear me and see it. Yes, Chris? Yep.
Yeah, that works great.
Fantastic. Great. Well, it's really a pleasure to be here to present this work. It's a paper that we've been working on for a few years and perfecting, and as usual, trying to shape a little better. So I'm looking forward to telling you kind of what we're on about and what I think we've learned about both the RMB as well as the particular application we have. So this paper is one where the title should be hopefully quite informative, or at least it has basically just a few words, but they are important. And so let me define them. What is an international currency? An international currency is a currency that's used significantly, not just residually, in international transactions. That is outside of the borders of the country where it is in. Everyone knows about how the dollar is not just an international currency, but the dominant international currency. But sometimes a little neglected is that there's a few other international currencies, namely the euro, the yen, the pound sterling, the Swiss franc, and the RMB or the yuan, who are also used internationally to a much smaller degree than the dollar. That's why we call the dollar the dominant currency, but they are still used. And while we have a significant literature on dominant international currencies, we have a significantly smaller literature on international currencies. So if you want, I would like to understand, why do some currencies, this is a paper about the Swiss franc, it's a paper about the RMB, it's a paper about the euro. Why do we have a few currencies like this? Especially since the literature on the international currencies, being quite US focused on the dominant currency status, tends to have very strong complementarities that push for there to be only one currency. And yet we do have these 5 other currencies that seem to persistently survive. And that's, as if you want, in terms of the research agenda, that's kind of what I would like to understand, why these currencies exist. Second, and that's the word jumpstarting, the RMB, and this is a paper about the RMB, like Christoph already gave it away, but I'm sure some of you, there was not much suspense here. The RMB is especially interesting because, again, a difficulty in studying international currencies is that one has to rely on very few data points, in that I told you there's only 5 or 6 international currencies, not that many there were and stopped being, and you either are or you're not, and then you tend to stay that way, which means that we really only have a few instances of a currency becoming international. We had the euro 20 years ago, the yen 40 plus years ago, but otherwise, to see when the sterling, the Swiss franc became international, you really have to go back in time. And for the dollar that we've studied somewhat, we really have to rely on economic history, and there's phenomenal work on using economic history of that. But again, we only have a few currencies that have really become international. So we want to focus on the RMB because here we are, a currency that 10 years ago was not international, or 12 years ago was not international at all, and became international. And so hopefully we think that as an agenda, we can learn about what makes an international currency, what jumpstarts it, and hopefully understand more about what international currencies do. On top of that, that is the general motivation. The particular thing that we're going to do is, starting from previous work that Saleem and I had done, we had started studying the central bank swap line network, represented here in terms of the swap lines or bilateral connections across different countries and where that existed. And this is where we started. And this swap line worker really has three poles: the United States, the euro, and the PBOC, or the renminbi. We had written a paper about the United States. I think we understood how this works. The euro worked pretty much the same. But as we learned about the PBOC swap lines, we realized that they were really quite different. And so in a sense, the models, the empirics, our understanding of the US swap lines is really very different from the understanding of how the RMB swap lines work. And it turns out, and this means both in terms of their purpose and their economics and why they matter. And it turns out that these two broad motivation, specific motivation, turned out to be quite related. Why? Because the reason why the currency swap line was started, as this quote from the governor of the PBOC some years ago was that, as he said, the creation of the swap line was due to the shortage of hard currencies and difficulties that Chinese banks had in developing corresponding banking relationships outside of China. It was to support and facilitate regional trade. The American swap lines, the dollar swap lines, the euro swap lines, are not at all described by these lines. Namely, the dollar swap lines really appear and have as a main purpose, at least in their last 10-year incarnation, as a way to stop financial crisis, to provide a lender of last resort in a scenario in which there was a big run, in which European banks, for instance, or just foreign banks, used to be financed by short-term money markets in dollars, and all of a sudden have a sudden stop in that funding. And we need to turn to a central bank, but they need to turn to a central bank to give them dollars. And the way we set this up was by having the Federal Reserve lend the dollars to, say, the European Central Bank, who could then lend it to the European banks, who could then therefore stop this outflow of funding and provide a standard lender of last resort facility. However, when it comes to the PBOC lines, as is really very clearly written, I wrote between the lines, but it's even more explicit than that, it has nothing to do with Pakistani banks investing in the Chinese financial market. It has nothing to do with South African banks borrowing a lot from Chinese money markets, as if there was such a thing, lending internationally. It had nothing to do with lender of last resort. Rather, the goal was internationalizing the RMB. In other words, jump-starting the international currency. And so, given that that is the goal, as we will show you, we can use the swap lines, and some of you may be interested in swap lines, in which case you will learn about the fact that the swap line is very different. Some of you may be interested in international currencies and international lending, as is the topic of the seminar. And for those of you, this is really using one particular tool, the swap lines, to identify how do international currencies work, what jumpstart. We're going to essentially do two contributions, or make 2 points, or you're going to learn two things, or we learn two things, I guess. Hopefully you'll learn at least half a thing and I'll claim success. One is that empirically, we're going to essentially use the PBOC swap line signed between 2009 and 2018, look at how many payments happen in RMB across countries. We're going to build essentially a panel of payments of RMB across countries at a quarterly frequency, or a monthly frequency, I'm sorry. And we are going to see to what extent is signing a swap line going to be associated with increased RMB use, as well as lower borrowing costs in RMB. As I will argue, and I explain to you the swap line in a little more detail, a swap line is nothing but a way that create an infrastructure such that if you want to borrow in RMB, you know that the tail risk that interest rates in RMB shoot up has been removed, because the central bank will step in, and as in any standard budget lender of last resort policy, will put a ceiling on how much interest rate rises. Because of that, it lowers effective expected borrowing costs. Because of that, it encourages me to now borrow ceteris paribus more in RMB. And if you borrow more in RMB, you may also be encouraged to, now that I can borrow in RMB, and here I am, my firm in Egypt, I can also now invoice more in RMB and collect other payments in RMB because I have the working capital to frame. And I'm going to show that these links seem to be clear there in the data. Then, to understand the mechanism, I'm going to write a model that expands a little bit on the literature on currency denomination, where really what I needed to do was, one, write a model, whereas I told you that literature is dominated by dominant currencies. I want to really do a rising currency, a jump-starting currency. And that model is also going to tell me why is it that a financial policy, a central bank policy, a lending policy can have an effect on invoicing decisions, which spill back over to lending policies and together create this jumpstart type phenomenon. And in that sense, the extent to which central bank policies can help in that jumpstart and so on. Moreover, the model is going to be nice because it was going to lead to some new predictions about who and what, in what circumstances the swap lines have larger, bigger effects that turn out to be borne out in the data. So let me tell you about our data to start with. First, here are the swap lines. They started in 2009 when the PBOC, as part of its internationalization of the RMB policy, and I already showed you a quote, started signing a series of bilateral agreements. And most of those were signed between 2009 and 2015. It became fairly flat afterwards with some other significant changes around 2019 and 20. But our example is going to happen in 2018. The way to think about a swap line is that it's nothing but a way for, and especially about the way the Chinese swap lines are written, the PBOC swap lines are written, it's for if I am an Egyptian firm who borrows in RMB, say from my local bank, who can give me a loan in RMB, and that local bank in turn may be getting its RMB borrowing from some Chinese bank, what happens if all of a sudden there is a sudden stop of capital to Egypt in RMB? What happens if for whatever reason the RMB interest rate goes up? And here I am depending on borrowing an RMB from my working capital. Well, at that time, what happens is that I can go to my local bank. My local bank will continue to lend to me in RMB because it can discount my previous credit at the central bank at a fixed pre-announced interest rate. My central bank is going to be able to therefore supply the RMB. And why? Because it's going to borrow the RMB from the PBOC. Or if you want, the swap line is going to be a loan from the PBOC to the Egyptian central bank that allows the central bank to provide RMB credit to the local banking system, where the local banking firms can lend into a straight credit, so that then the firms can count on it in order to borrow at a cap. It is not a direct subsidy because it is, like with any discount window lending, simply a ceiling on the borrowing cost that you have, on the offshore borrowing cost, on the cost of borrowing in RMBs. Here are the countries, by the way, if you kind of want to see their names, but you already saw the map of where they were spread out. But that is the data that we're going to do. What we did was spend a little bit of work, or maybe a lot of work, in trying to collect the data on exactly when each of these was signed and with which terms. Sometimes that involved using some PBOC announcements. Very often it involved using news reports and then going to the central banks of these other countries and from them learning exactly what the conditions of the swap and how they were signed. Then we complement this with another source, and this is a data that we make available. Christoph and others have also now just built and expanded it to more recent times and complement with others. But and we are ourselves actually doing a new extension of it in a different context, which we'll make available soon. But these data on swap lines we've now is all publicly available after somebody has put in the cost, and we have for you of those terms and those dates. This data, sadly, is one that was available a few years ago when we wrote that paper, and sadly is no longer available as far as I know. So SWIFT, which, as you know, is a messaging system, gave us access, and a few other researchers for a few years, and there was a few papers in it, but sadly they've stopped giving access to essentially at the country level bilateral payments data. And essentially every time you do a transfer across a bank, there's a SWIFT message, and we basically have those messages on how much was sent in which currency between which country at a monthly base. So these are the cross-border banking message. We don't know who's making the payment. We know a payment is being made in a certain amount, but crucially, we know the currency. Okay. Now, we know that in trade, invoice and payment are almost always the same. And we can use that we do have information on what it was used for. And so we're going to use both total payments as well as the payments that are said, these messages that are said as being for trade finance. And what's that going to allow me to do is that it's going to allow me to the RMB share in cross-border, non-FX payments. Very important, this data that almost half the data is payments having to do with the closing of FX swap positions. So we're going to look at the non-FX swap payments that are sent and received per month per country. So the virtue of this data is that on the one hand, it's not firm level, that's the vice. The virtue is that it really covers the whole world, and you can really get a sense of how much each country is paying of the currency. You can really get these jump-starting international currency effects in a way that a micro data set would not, because the typical micro data set would be just for one country. And you would not be able to know both Egypt, South Africa, and all these other countries how much to use RMB. So those are the plus and minuses. For our goal, since it's going to be variation in when a swap line was signed in a country, swap lines are not signed with individual firms, but countries, this is the right data set, not a data set on firms, but a data set on countries in order to be able to identify what we're trying to identify. First, look at the data. Here are the swap lines signed again. Here is the RMB share. First, look at the data says, boy, there seems to be some relation here. That's important. At least there seems to be something. We're not going to have to torture the data excessively to at least find that there's some connection between these, even as we exploit that connection. Second look at the data that is important is that when you look at the share of RMB payments, you quickly learn that a few countries, it is very large. Countries need to buy Mongolia, Hong Kong, Macau, as you'd expect. Iran, because they can't use dollars. So there are some of the large ones. But you also understand, therefore, that a lot of countries are really close to zero or even at zero. That in the end, if you're trying to run regressions and you are focusing on the intensive margin, which is used, you kind of would be mistreating the data a little bit because you really be driven by whether there's a few of these large countries. And so we're going to be really focused on the extensive margin. Do you go from zero to some in terms of using the RMB at all? And there are quite a few zeros, a lot of countries that don't use the RMB, and some that use it. And so that's what we're going to be doing. Okay. We're also going to be focusing on developing countries just because since we want to focus on trade, we don't want to get payments in RMB to great financial centers like London. It's actually really robust to including London in the US, but for the most part, we're looking at countries that don't have large financial centers. Essentially, it's really excluding London, the US, Great Britain, and Switzerland, and Japan, so that we don't get a little bit of a double counting of the fact that the other ones are international currencies. That's where we get that. So here is, if you want the picture, and then I'm just going to butcher you with tons of tables and regressions, but really all they do is show you that this is a robust picture. If you look at the median RMB usage, before a country signs an RMB swap line, it tended to be 0. When a country signs a swap line, we see a clear jumpstart over the first 6-12 months, that maybe even grows a little later, but by now you're running out of the sample. That is, the RMB share goes from 0 to something like 3 to 4%, seemingly coinciding with the payment, with the signing of a swap line. The swap line seems to be not sufficient, but at least suggestively necessary to start this jumpstart phenomenon. If you look at the mean instead of the median, you get the effect again instead of the median country. So again, this is a comparison now between countries that don't sign a swap line and countries that sign a swap line. And you see that the mean RMB usage increases again to something along the lines of 2 to 3% after a swap line is signed. And that is really the key fact. It seems that RMB payment share swap lines jumpstart an international currency. Let me, well, enough plots. Let me show you a baseline specification. Our baseline specification is, do you make payments in RMB or not? It's going to be a linear probability regression, or we're going to do probability. We're going to do some Poisson regressions as well on individual fixed effects, time fixed effects, or month fixed effects. Whether did you sign this country signed a swap line or not, with some controls that I'll discuss and some error. Note that this is really, and this is why I like this picture, it's really a diff interpretation. I'm looking at 2 countries, one signed a swap line, one did not. I am comparing the RMB usage between the one that signed and one who didn't before and after signing the swap line. And this is basically the standard diff specifications you'd expect. To be clear, we have 21 countries that signed the swap line. I guess that was a little too quick, but there were 21 countries here, or a little bit more. But like I told you, I'm going to take out the ECB and Hong Kong. So we're going to have 20 countries in the treated sample, and then I have another 100-ish countries in the non-treated sample, and that's the comparison to do. This is a staggered diff because, again, countries didn't all adopt swap at different times. Indeed, one of our strats for identification is precisely the fact that the signatures tended to be correlated with state visits of the PBOC and or the Premier Minister of China, and therefore they happen at different points in time, arguably even exogenously. Even if we had negotiated swap line, the date of its implementation often coincides with whenever the date of a particular state visit happens. And so it's a staggered if. So you're going to use some of the, we've now used, there's 2 or 3 different econometric methods. We've actually used all of them, but the baseline results are going to use one of them for staggered if results. Controls and important, okay? That is, what is the concern in this regression? Maybe there's something that led to the country sign the swap line, and it's the same thing that led it to use the RMB. In other words, maybe something changed in Egypt that meant that it now wants to both have RMBs and wants it to call up the PBOC and say, can we please get a swap line? Right away, in the way I described it, this is a little incredible insofar as the PBOC, for the most part, called you, not you called them when it came to swap lines. That's just the way in which, like I told you, the politics of this happened. And really, it was really political, meaning the PBOC wanted to have swap lines, the reasons I told you, to promote foreign trade, but the date at which they happen, and that's why it's important, the diff and diff, the way to which we had it happen was timed with political visits of the premier to the country. Still, controls. Could it be that a country started trading a lot with China because of that? It has RMB payments, starts using RMB, and on top of it signs a deal? Well, we're going to control for whether there was a trade agreement with China or not. Important, because again, as part of state visits, sometimes those were signed. We're going to control for the size of exports and imports from the country. We're going to control, and the idea being that could there have been any change in economic relationship with China? It may have been more generally Chinese policy. We're going to control for whether there's an RMB clearing bank, whether you're a membership of the Asian Investment Bank, direct investment flows. The key here is that whether these policies are, if you want, we want to control for whether it's other policies that are both leading you to pay more in RMB and sign the swap line. And we're going to look at whether also controlling for the RMB share by country neighbors if there's any region-specific factors, okay? Here are the results. If you have no controls, the effect is roughly a 0.3% increase in the probability use, or a 30%, I'm sorry, increase in the probability you use the renminbi. Once you add all the controls, as probably you should, you end up with a very consistent 13% increase in the probability that you use the RMB. Now, that is the baseline result. That is using as identification a diff and diff, the exogenase I told you of when you signed it, and controlling for what could, I think, potentially be plausible confounding factors. But let's go a little further. What about the intensive margin? I told you, I think the extensive margin are the better regressions, but hey, let's look at what the intensive margin look like as well. When it comes to the intensive margin, we also get an effect, and the effect, consistent with the picture I showed you earlier, is that when you do the effect on the RMB share, you end up with a number that corresponds to approximately an increase of 1%. And note that the RMB share during our sample period goes from 0 to roughly, as I told you, 2 to 3%. So this says that the swap line alone will have accounted for something like a third of the increase in it. You can also do these pseudo-Poisson maximum likelihood estimates. Then these coefficients then tell you the probability of how much the increase is. Translating these numbers into the RMB share, you end up with a very similar number of roughly 1%. That's how you should read this 1% being very consistent with that 1% in this context. But as I told you, the mechanism though, so it seems like there's a connection here. The mechanism is that a swap line should lower your ability to borrow in RMB, and it's that ability to lower less in RMB that leads you to make both borrow as well as invoice and pay more things in RMB. Let's look at borrowing costs in RMB. Now, turns out to be quite hard because there's no RMB denominated borrowing costs, but we measured it. And the way we measure it is you look at how do you swap a local currency to dollars and then use the dollar to RMB, that is the triangular trade, to go and do it. And so we went and measured those. And here is the measure of the average RMB borrowing costs before and after the swap line. And here you have, very strikingly, supporting the point of what swap lines do, that swap lines reduce average borrowing costs in the currency. So you have that it's the reduction in the borrowing costs and the same that use of the RMB. Here you have it as a picture. Here you have it basically on how much it is, but essentially signing a swap line ultimately lowers your ability to borrow the RMB, the cost of doing so, in as much as 1% on average. But let's look even forward and let's look for some exogenous variation. So in 2015, there was a big reform in the way that the liquidity in the Chinese Hong Kong versus onshore market worked. And that big reform essentially meant that, and the reason was that in 2015, there was some volatility in the exchange rate between onshore and offshore borrowing costs. The PBOC had liberalized the ability to borrow in RMBs. And through that reform, by removing liquidity from the interbank market in Hong Kong, it really had a very large impact on the ability for, say, an Egyptian firm or a European firm to borrow an RMB abroad. And by the way, that seemed to have coincided with the RMB stabilizing at its 2% share that it is roughly now, 2-3%. How can we use this? Well, the way in which you can use this is that in reverse rate types as well as in trade finance. Well, remember, what does the swap line give you? It says that you no longer depend so much on the interbank market. So we have this fun application. The PBOC, in a sense, constrains activity in the interbank market, but some countries had another PBOC policy signed the previous years, the central bank swap line, that allowed you to, if there was problems in the interbank market, at least get some insurance against those problems. So this gives you some very nice variation into to what extent do the countries that had a swap line, were they more immune to the CNY reform and the effects of it? And we do this, again, in diff and diff by essentially creating the synthetic panel through a nearest neighbor match. And what we see is that precisely it was those countries that had a swap line on which the share of the RMB was less affected. It was essentially the country that signed the swap line that seemed to be able to navigate, not have this contraction in RMB share as much as the other ones did. In other words, the swap line served exactly the role the theory would say it is, which is that allowed you to get insurance against fluctuations in RMB lending. Finally, you may think, oh, as I told you, what if we look at trade finance specifically? The results are very robust to that. But a few more results in case you are worried, or at least to kind of give it a little bit more color to the results that we're finding. If we exclude payments to China, the results still hold. If anything, they're actually much stronger, meaning this is not about the swap line allowing Egypt to pay more to start importing from China. Actually, for the most part, it was already importing from China. It is the fact that where the effect is even larger is that Egypt can now start invoicing RMB when it sells to, let's say, South Africa. That effect is even stronger in this probabilistic sense. Let me skip that. This is also not about trade with China. The swap line, again, signing the swap line has no effect on whether you start trading more with China. What it has an effect on is whether you can borrow from China and whether you can start invoicing in RMB and borrowing in RMB as well. Yes, let me do that. Now, in my remaining 15 minutes, let me move to the second contribution. And that is, to go a little further, we want to write a model to understand this interaction between the choice of currency and credit and the choice of the RMB. And so let me tell you what that model is. This is in the spirit of the simplest model that we could write. Think about firms as choosing a technology in terms of, do I want to use inputs that are sold to me in RMB, or, since this is theory, let me be more general, in a rising currency, versus inputs that are sold to me in the dominant currency. Luckily, dominant in dollar or rising in renminbi are the same subscript. Okay. As standards literature, you're going to have some sticky price, so that there's going to be an invoicing choice. If price were flexible, then invoicing currency is irrelevant. You know the average interest rate in the rising and the dominant currency. You know the relative cost of inputs. But when you come to now having set up whether you're going to get your working capital in R or in D currency, when you go and buy the inputs and do the borrowing, there's a shock to the interest rate and to the exchange rates. And so that means that you may have made a mistake in choosing to borrow in renminbi or dollars, because it turns out the renminbi rate just went up a lot. Or you may have made a mistake in invoicing in dollars instead of renminbi because there was a massive depreciation of the dollar, and now you're getting paid very little. So that the exchange rate, the sticky price, has a standard in invoicing literature. Our novelty is, what about the fact that you also have to get working capital and therefore you need to borrow? Finally, period 2, you sell and repay the debt. In this model, you can order firms and order markets using J's and I's and you have that, and that ordering is such that the more volatile is firm-specific interest rate risk, you'll be a higher J. The more stable will be the bilateral exchange rate, you'll be a market I. And then there's, of course, the D and the R market, which are not here in the square just because they have positive mass. These are all otherwise infinitesimal. But think about this as many firms in Egypt selling to many markets all over the world. Let me just again, to elaborate, well, I don't think I need to elaborate. The way we particularly measure it is by saying we can either, again, use inputs from RMB and from dollars, and you're choosing ADA. You're choosing how much of each you want to do, knowing the borrowing costs, and knowing that borrowing costs for the RMB are more volatile. That's why it's a rising currency. You also pay for the other input. There's another input, the domestic input, and therefore you have some particular cost function. But again, don't pay particular attention to the loss. You're going to choose whether to invoice in Egypt. You can either invoice in dinars, and if you're selling to the UK, in pounds, or in dollars, or in renminbi. And again, here, the standard problem that there's going to be some market demand and some shifters here, both to demand as well as to the other one. And so the problem here, again, classic in this Rigobon, Itzcocky, Engel, Devereux literature, is that firms are risk neutral, but you want to set a particular optimal price. Because you set a sticky price, you set a sticky price and a borrowing cost, you're going to be subject to shocks to demand, shocks to your marginal cost. And those shocks are going to mean that because of sticky price, you now would have wanted to set the price in the other direction. And because the profit function is convex on the concave in the price, you effectively want to hedge that risk that you're setting the wrong price. And that desire is what leads you to pick the currency that gives you the best properties of that. First in the model. First, and that is an important result. Firms always choose to either borrow in renminbi or in dollars. They never choose in between. Why? Because firms are risk neutral. They want to choose the cheapest one. Invoicing is where this argument, as I told you, of concavity of the profit function happens. But it comes to whether we want to choose, which one you want to choose. You want to borrow in one versus the other. Second, if you, let's say, but we could do the other cases, are choosing to invoice in renminbi, when do you want to use RMB credit instead of D credit? Well, the benefit of borrowing in renminbi is that you align the denomination of your marginal cost and your marginal price. And so you really like that. And that benefit is really high when there is a lot of variance in the renminbi. You're already borrowing in renminbi. You really want to invoice in renminbi if the renminbi is very volatile to your currency. The cost is that it might have been that the dollar instead of the renminbi was a much better hedge in the sense of correlation with your other input costs, or with the demand shocks, the exchange rate in the other currency, or with the shocks that are affecting that other one. That is, in other words, you are really trying to choose the renminbi as long as the renminbi volatility, if you want, is higher than compensating for potentially its lack of being a worse hedge with respect to the shocks. If a firm chooses our credit, then this is a condition choosing our credit, then you have a complementarity. Because now that I have our credit, I want to do RCP. Why? I want to do RCP because now that I have the hard credit, now I have some of my costs, my profit function shifting whenever our costs happen. And by choosing RCP, I am choosing to have that shift less, or at least those shifts be correlated with the adjustment, automatic adjustment in price, and as a result, being able to sell more. So first result, proposition one, is really that there's a complementarity. This complementarity is probably not too shocking. It's not too shocking because this is a complementarity that the literature has emphasized in terms of complementarity and why a currency becomes dominant, or at least more recently in the work of Dima Mukin and others, between the inputs and the outputs. But here is where we had to write some slightly new theory or some slightly new model. When does the firm choose the R credit? The firm chooses the R credit when the expected borrowing costs in renminbi are low enough. Okay. But that low enough depends on the relative price of inputs in renminbi. Okay. And it depends also on the relative size of the renminbi and the dollar market. Okay. In particular, if the Chinese market for trading is higher, then because I'm selling more to it in the first place, then the benefits of our renminbi are going to be higher in the first place. What does a swap line do? What the swap line does, as I told you, is put an upper bound on the borrowing cost given by the swap rate, epsilon swap here. Therefore, because of first order stochastic dominance, the left-hand side is going to fall. Because this is a threshold rule on whether you choose our credit, because the our credit choice, as I told you, is bang, bang, you can jumpstart your currency by lowering this. So what happens? You start in a world where in Egypt, we're all using dollars or selling in pounds when we're selling to our different markets. We may, for instance, use renminbi only insofar as we sell to China. And when a swap line comes, because it holds that threshold, what that happens is that all of a sudden a series of firms, a series of firms and a series of markets, the firms whose costs were more aligned with renminbi and the markets in which the exchange rate with renminbi was more stable, you're going to have a lot of Egyptian firms that now choose RCP as their currency instead. That is, you're going to choose now RCP and the currency goes from 0 to a jumpstart as a result of the swap line. So that's roughly how the model, I think, captures what it is. But here are the insights that you get from the model. One, you get, as I said, an explanation of why through the borrowing costs, you get this complementarity and you get a jumpstart effect, a complementarity effect. But second, I think the model helps to highlight why is it that we have so few international currencies? Because again, if I had written to you a model in which there were no thresholds like this one, then you would expect that the Egyptian dinar also has a swap line, also is used internationally. All currencies are used internationally. But no, you must cross this threshold given the bang-bang nature of the policy in order for the renminbi to be used. Why, therefore, are so few for international currencies? First, for many countries, the ability for me in Egypt to borrow from South Africa, say, the credit itself is just too expensive. That's the roles in my model. It's simply too expensive to borrow in the first place. There just isn't enough even of a South African credit market. Second, South Africa is just too small a share of the sales of Egypt. Because the size of the market is smaller, that weakens the complementarity. Third, the South African rand is just too volatile relative to the Egyptian dinar. I'd rather invoice when I sell to the UK in pounds than invoice, say, in the South African rand, simply because local currency pricing then dominates completely that currency pricing. And third, because most currencies are the South African currencies pretty much uncorrelated with wage and domestic costs in Egypt, less so for the Chinese one because of so many imported inputs, but because of that, you don't want to do it. China, why was China able to jumpstart? Why is it that swap line mattered? Because already you had that as a result of the other policies, borrowing in Chinese renminbi was low enough. China was large enough. China had stabilized the exchange rate, and China was a big enough input supplier, and therefore meant that the other inputs already, all the inputs that firms had, were already somewhat correlated with Chinese. Third, though, and further predictions, and again, you don't have to read all of this, but it is more likely that the swap line will have an effect if the size of the country already was exporting to RMB more. Second, if it turns out that the correlation between the RMB and the domestic costs is larger. And thirdly, if it was borrowing more in the first place. That's the other side of why these didn't happen. But this gives me some nice new predictions, because now, and these I think are not obvious unless you have the theory, which is within the countries that adopted the RMB, which ones made it more likely that they did within the countries that signed the swap line, which ones were more likely to adopt the RMB given this. And here we have that. The effects swap line heterogeneous. The effects are much larger for countries that before the swap line had higher trade with China. They are larger for the countries where the covariance of the RMB exchange rate with domestic PPIs was larger. And they are larger also in countries that, to start with, have a larger share of intermediate inputs and of export working capital. So the theory or the data is consistent also with that side of the theory, if you want, that is consistent with the story that I think we're telling, And the story that we're telling is one in which countries in Egypt would want to, with a swap line could now borrow reliably stable in RMB. That triggered them to, once they start borrowing in RMB, to want to start selling more in RMB. That selling more in RMB led them to also want to buy more imports from China in RMB. And that complementarity led to these combined desires, to the RMB going from being zero to being positive, and this force being stronger in some countries. Let me conclude in my last 3 minutes. I think I have 3 minutes. Let me conclude with a little bit of background as well. Let's go back 110 years to, or 111 years actually, to the Federal Reserve Act. In 1912, the US was the world's largest exporter, but dollars were not used at all in trade finance. The capital was London. Every US export was invoiced in pound sterling. Okay. We all know the Federal Reserve Act as, of course, creating the Federal Reserve and its policies with respect to interest rates and inflation. But a little less appreciated, certainly not by people in this area, but certainly by, let's say, the broad audience that I think is signed up for this talk, is that Benjamin Strong, the first president of the Federal Reserve Bank of New York, had a very clear mandate mission with the Federal Reserve Act, which was to create New York as a financial market. And the Federal Reserve Act deregulated the financial sector in that it allowed US banks to actually open branches abroad, which they couldn't before. The Federal Reserve Act, of course, allowed for a stable exchange rate of the dollar. But very importantly was Benjamin Strong creating a facility where it became a buyer of last resort of trade credit in the New York market. That is, the Fed, throughout the late 1910s and 20s, created what today in spirit would be almost like a swap line, in saying that if you had trade credit in dollars, US banks could go and discount that and get dollars, and even foreign banks as well could go and discount that and at the New York Fed. Now, it turns out that this policy led to, and Barry Eichengreen has written about this policy, led to the dollar jump starting and becoming dominant. Were the polls of Benjamin Strong, including this very aggressive buying of trade acceptances or trade credit, cause for it, or was it just luck? Was it just luck that the dollar became? Was it just inevitable in a sense? Well, step back 100 years later, and China in 2009 was the largest exporter in the world, had become a world creditor, but the RMB wasn't using it at all given capital controls. Starting in July, what did the PBOC do? It deregulated by allowing settling in RMB that happened in neighboring countries like Mongolia and Singapore. It created the Hong Kong offshore market so that firms could actually now lend abroad. Banks could now lend in RMB abroad. It, of course, has had a somewhat stable exchange rate, and it created the buyer last resort. The result of this was RMB went from 0 to being something like 2 to 3%. Is it again inevitable, or did these policies help? What this paper did was try to isolate the impact, at least of the PBOC swap lines, and show that it did seem to be policy. It was not just luck or inevitability that led to the RMB being used. Policy played a crucial role, and therefore Benjamin Strong played a crucial role as well in the dollar. Namely, we showed in a model and empirically that international currency status depends on whether you have financial markets. International currency status is not just about trade per se, but about whether can you borrow the working capital in that currency. The development of their financial markets and the ability to get working capital credit depends in part on central bank actions and in policies. And so policy and central bank actions that promote the liquidity, the well-functioning, in this case, the lender of last resort of borrowing in your currency, will push your currency to be international. And surprise, surprise, that also happens to be the case with China, with Switzerland or with the UK, where you have that financial market infrastructure, much of which built by the central banks. Empirically, we found that the RMB swap line indeed removed the right tail risk of RMB financing, and in doing so, increased the probability of a country making or receiving RMB payments. And in a model, we show that there were thresholds. There are thresholds that most countries do not meet, and therefore you have so few international currencies. But if you get these thresholds met by having a deep enough capital, by having a financial market where people can borrow in your currency, by being a large enough player in international trade, and again, and having a stable exchange rate, you can jumpstart to become a currency. And let me stop there. 4:47. Sorry for being 2 minutes over, but yeah, let me stop there. Questions?
Great, wonderful. Thank you so much. This was a great presentation. I suggest we open it up straight to the audience. Just raise your hand, and then you can pose a question. Come in and pose a question, or write into the chat. Either one of the two. Please, Mihena.
Yeah. Hi. I have a quick question about the credit decision of the firms. Could it be that in case of default, credit in renminbi would give you an easier way out of it, as opposed to credit in US dollars that you would have to maybe settle, default you have to settle maybe in English court or London court? Now, the nature of contracting and crediting, they sort of go hand in hand. And you already alluded to all these political things. So maybe some of these big companies, they might be afraid of having to deal with courts outside, or, you know, there's all these other things. Could these also help further motivate the results?
So absolutely. And so let me, as I said, what I think we're trying to isolate and what we're trying to emphasize is that whether it is procedures for default bankruptcy, and how transparent, how agile, how efficient they are, whether it is the creation of creditor and debtor rights, as well as courts to settle those rights, insofar as all of those create a financial infrastructure, that infrastructure that creates the ability to borrow reliable in RMB, if you're a company outside of China, that has a strong effect on whether you choose to do so, of course, but also then spills over to whether you want to start invoicing your own sales in RMB, as well as buying more imports in RMB from another country. All of those policies, that's in many ways the mess of this paper, financial policies do have an impact and have an important role in international currencies. We, of course, in our paper, what we've done is do the, if you want, usual economist thing of, let me look at one financial policy, the swap lines. Not to say it's more important, by the way, compared to, again, default procedures, credit settlement, and others. But let me look at one of them for which the features of it allow me to isolate very clearly the way in which it would affect these financial conditions, and in effect, these financial conditions, therefore, allow me to identify this process. And that policy allowed me to, therefore, measure that indeed these financial policies matter, indeed they're significant, indeed they play actually a very large role, potentially, in increasing the likelihood that your currency jumpstarts, your currency becomes international. But in a sense, our paper is very much in the spirit of what you were saying, in the sense of financial policies matter, but the one we isolated happens to be the swap lines and not anything to do with default or the points that you were making. Of course, I would love to write papers on that too. If I had that, imagine now, and let me get it, this is really in the realm of imagination, the Chinese authorities somehow would go and sign contracts or provide consulting advice to countries all over the world in a staggered way on how to allow for better credit discharge and credit settlement procedures for anyone who borrows in RMB in Egypt, South Africa, Turkey, or whatnot. Then I would be able to write a paper like the one I just wrote and test for your mechanism directly. Instead, I'm testing for the swap lines, but speaking more broadly to this whole point and agenda that you've noted.
Many thanks. And the last question, I think you already mentioned about the Asian Investment Bank, but could it be that these swap lines were actually put in place looking forward a decade, expecting, for example, the One Belt, One Road to, in a sense, it goes exactly in the same direction as the mechanism you proposed, but it would put somehow a little bit the swap line out. It would put it in a broader policy that is actually much more about trade, perhaps, than internationalization.
So, two answers. First, in a broad sense, certainly the swap line was a package of policies, all of which trying to contribute to both more trade, more lending, as well as more use of the RMB. So they're certainly part of the package. If it was the case that either signing One Belt, One Road contracts and joining the AAB were perfectly correlated with signing a swap line, then I wouldn't be able to distinguish it. But it turns out they're not. There's actually quite a few countries who sign a swap line without it, and likewise in the other direction. So I do have variation data to distinguish these. And what I've shown you, and now much more narrowly from an identification perspective in the paper that I showed you, it turns out that controlling for whether you were, again, becoming part of the AIB or signing a Belt and Road contract turns out to have no effect on the impact that the swap line does. So from an identification perspective of what's the impact of developing financial market through the signature of this swap line, developing your RMB financial market, then the IAB turns out to not change at all our results. That is not to say that the IAB does not contribute to the RMB. Those are just very separate questions.
Thanks, many thanks.
Great, more questions.
Yeah, Kathleen Tyson.
Oh, thank you. That was great, Ricardo. I've built a lot of infrastructure globalizing the dollar, got treasuries into Clearstream, globalized use of treasuries. So it's exciting to see new models coming out. I guess, it's going to be maybe not your area, but 8 different payment systems opened to global use last year, which seems to parallel the shift towards credit and transactions in local currency. I know the data is very problematic because since sanctions, everybody's hiding their data. And SWIFT, of course, is very incomplete. But is that something you're looking at in terms of payment dynamics?
No, I mean, in terms of what I'm looking at now, but let me, okay. In the scheme of at least the talk that I gave and what I've learned in this research, let me give you just some observations on what you said, Kathleen. But no, we are not looking at that. Let me tell you. Let me give you a slightly then longer answer and tell you why we're not looking at that. So, first of all, there are 2 opposing forces here. One is, of course, that if I am, and again, I'm going to keep on picking on Egypt. Apologies to the people from Egypt in the audience. It's just one particular country. If developing payment systems in the Egyptian currency will in principle allow the Egyptian currency to be more used relative to the propensity to use the dollar by Egyptian firms selling abroad, or even by Egyptian customers buying imports, into Egypt, okay? That will help. At the same time, because of the complementarity reasons that ourselves and the literature before noted, meaning the fact that Egypt will have a lot of imports in Egyptian currency, because Egyptian companies will be borrowing a lot from US financial markets and thus in dollar, that provides for a very strong impetus for Egyptian firms to also use the dollar. And this is really the dominant currency literature that notes that there are strong complementarities, and insofar as you're a multinational using the dollar, there's then going to be a strong effect for you to use the dollar across many operations. I showed you how other countries that want to compete with the dollar, in this case, let's say China, by creating a set of conditions, can at least start competing. But again, competing here is getting from 0 to 2%, where the dollar is up there with 80%. But it can at least start entering this market. Doing a lot more when it comes to China would require, and the theory there is pretty explicit, would require doing just a lot more that perhaps China is not willing to do or does not desire to do. For Egypt, though, to want to have more of its local currency used, well, there, I think it's very much more of an uphill struggle, subject to the fact that you have all these complementarities from these international currencies, at least in your international export sector. There's already a strong force for the Egyptian currency to be used, as it is. in Egyptian currency, but for it to start using its currency international, that is for it to start pushing for that, its firms can start selling in their domestic currency. That is very much of an uphill struggle. That will be very hard because of this complementarity reasons that are highlighted in this theory and so on. So it will always be very hard. It goes back to that prediction of why you're going to have few currencies being international, including the Egyptian. So that's the first answer just within the setting of paper. I think you raised, though, an important point, which is precisely also on what are next steps. And so let me talk about next steps in terms of both Chinese lending as well as the growth of international currency. As I showed you, the swap lines were a very important part of getting the renminbi to get jump started. But there are two forks in the road here that are hard. And so they've allowed more international lending, not by the PBOC, because by the way, the swap lines, being a lender of last resort policy, involved at first not that much lending coming through the swap line. They were really there as a backstop, as a lender of last resort. But now this has evolved in two ways, maybe they were inevitable ways, but two ways. The first one is that to keep on growing, it would require a lot more development of Chinese financial markets that have, to a first approximation, not been done by the PBOC. And the RMB has not risen that much over the last few years, over the last 10 years or so, or not 10 years, over the last few years in terms of share. I would, again, inspired by the stock, argue that that was partly a policy choice. It was not just bad luck that the RMB went from 0 to 2 and then stay there. Partly was a desire not to. And that's a perfectly legitimate desire. We can have a very different discussion on whether it's even desirable to be an international currency. But then there's also a second point, which is, and here, luckily, because Christoph is in the line as well, and some of his more recent work on international lending in China, is that, of course, China has started lending through not just the private sources that the swap lines support, but also through a series of official lending sources. And on top of it, the Chinese swap lines, which I explained to you how they worked in my sample, 2010, 2018, how they work trade credit policy that allowed for lending of last resort, over the last few years have started being used more for official lending, which is the point that Christoph has in his paper. During my sample period, which I love because in my sample period, they weren't used in that way that much, and that allows me really to do the separation and identification and identify these theoretical concepts that I want. They were not. But if I wanted to write, imagine that the Chinese central bank went and now signed 10 or 15 new swap lines in the next few years. And I said, oh, great, my sample just doubled. Sadly, it's not as good as that, because the way the swap lines are now being used are also for forms of actual official lending, as again, Christoph's paper has shown and others. And so they no longer allow me to separate the effects that I was separating. And so it is important to note that in a sense, I guess I shouldn't say this too out loud, my paper is almost already obsolete. I mean, it's obsolete insofar as the new swap lines are going to have different effects. It's not obsolete. So if you're my referee or my editor, it's not obsolete. Hold on. Just insofar as in the sample that we're using them, they had a very sharp and precise impact that is very good for us to identify the things we identify in theory and to understand the jumpstart. But the way they're being used now, and maybe that's inevitable with any policy, they've now become a mix of a bunch of different other things. And as such, as an academic economist, in some ways, much tougher to use because now in a clean, identified way, as a predictor of the future and understanding the role of China in the financial system, more excited because they become broader and they're now having more different channels that are hard to identify, but potentially more powerful. Hope that was clear. Sorry, I went on a big tangent here, but
wow, that was great.
It is helpful, and in particular, I was thinking about the relevance of a data set that stops in 2018, given recent geostrategic change.
It's very important for stop in 2018 for what I'm using it for. Again, as an empiricist, we don't want to isolate a causal mechanism.
It's SWIFT data, and I know how problematic that is. And yeah, you keyed on something there that, last month's payment to the IMF in CNY was drawn on the swap line by Argentina.
I agree. I know. So, yes, so we could talk a little more about that, but again, Christoph can also talk a lot. I guess we could have a fun chat that way. The swap lines in my sample period, they were not used in that way, but they've started being used for a bunch of other ways. And that would immediately wreak havoc with my identification.
Absolutely. Absolutely. But it is interesting to see it evolve in real time.
Ricardo, following up on that, so I find the mechanism that you show super convincing, and I'm thinking like you're seeing kind of swap lines being used by more and more countries, right? This is not just China. So I would be interested. I mean, now that kind of you see the rise of Southern economists becoming more important in cross-border central banking, in international lending. Do you think this is a mechanism that will become more common? That I would be interested to kind of say, is this become like a standard way of or might this become a standard way of jump starting? And I think what you said, that's my first question. What you said that now it's being used for other forms. I mean, that's in a way is a fascinating. The Chinese really adopt, and you see them. To me, it's really interesting. So I wonder, whether also looking a bit at history, you've looked at swap lines a lot, and they have been used already in the 60s and 70s. I don't know the history of that, but I would be interested to know, whether countries have in the past used that to jumpstart and might be using it more. Yeah, sorry.
Very good. So let me 3 points, or following that cue. First of all, we are, as I told you, we are updating the data sets on swap lines and writing a new paper. So we'll have a new paper, I think, by the end of the summer, that is precisely documenting how the swap line network has grown quite a bit, and showing the effects that it's having on financial markets right now. So I'll leave you for that, but Saleem and I have a new paper coming out in the summer, essentially verifying what you just said, Christoph, and trying to show that now that they're having certainly multiple effects and used in different ways, but at least giving a sense of what of their direct impact, at least in prices. I mean, yeah, at least in some prices. I will say, and again, preempting a little bit that paper, the swap line coverage, if you want the punchline of that paper, is actually much bigger than you think, because the reason is that some countries may not have a swap line, for instance, with the Fed, only a few do, but in many countries now you can get a swap line, but there are some countries that have a swap line with the ECB. I can therefore get euros from the ECB, and because the ECB then has a swap line with the Fed, I can, through a second and third order, now effectively recover the swap line. Indeed, one of our first results, I'll reveal it already here, is that something like 90% of world GDP is nowadays covered by actually dollar swap lines. So talk about dollar, even if only indirectly. So it's actually much larger than the direct effects once you take out the second, third, and fourth order because of this. So that one, just first point, yes, we are trying to writing a paper on that, documenting that network and its direct effects, knowing that, again, you no longer have the clean identification for those because they're being used for less. Second, are other countries trying to jumpstart? I think the theory in this paper is very useful in showing that that's really an uphill struggle. It's just very hard. You can start your swap line all you want, but unless you have these other conditions in my thresholds in the proposition, you're not going to be able to do so. And so you really, in a sense, that just reflects itself in that when we talk about swap lines, we're talking about there's a poll in the US, there's a poll at DCB, there's a poll in China, there's a Chengmei initiative, and not many others. I mean, there's really like 3 or 4 polls coinciding with the international currencies. And that is, other ones, I think, would be doomed to fail, at least in jumpstarting the currency. I think that's an important result in our paper. So our paper should not be read as saying a swap line, or I think I even said this, a swap line, I think, becomes, or a development financial center is an important promoter of you getting international currency, but it's very far from being sufficient. And so you will need others. Third point that you asked, though, was about the previous swap lines. And here it's important. I mean, by the way, there's wonderful work and even a whole book by Catherine Schenk and wonderful on some of the older swap lines, especially in the 70s and 80s. It's important. And also myself and Saleem have written a survey on this for the annual review of financial economics on a little bit the evolution and historically. The current swap lines are a little bit different from the previous ones, but let me do a rough distinction. There used to be a long network of swap lines during Bretton Woods to essentially peg exchange rates. This is your way to get the dollars or the gold you're missing in order to peg your exchange rate. Those swap lines exist today in the Chengmei initiative. That's in some ways a little bit of why they exist there in some regard. But for the most part, they've disappeared with one very notable exception. The Fed Mexico swap line, which still survives from all those days. But for the most part, with the exception of, again, swap lines to intervene in exchange rate markets are not the ones that I talked about in this paper or even in my other work. Then there's a type of swap line, which is the one to keep financial stability in a world of global capital markets. Those are the Fed and the ECB swap lines. They've been very successful, so much so that they were used already again in the pandemic. Those seem to be an important part of the international financial architecture. And they're, for instance, crucial for the dollar to continue to be such a dominant global currency. Those, I think, the only growth that will happen there is with the dollar, especially in the Fed, wanting to expand it more or not. But it's really about the international financial architecture, and that was the topic of my first paper. Then there's the third type of swap line, which is the one that we talked about today, which is swap lines to promote trade credit. Those, yes, you can have a lot more on having your swap line try and promote more trade credit, even if you fail to make your currency into an international currency, but you can use them more if you want, and insofar as doing that. And those, you can sort of see more action. And then comes the, as I told you, the slightly more confusion of how different swap lines have evolved, which is, what if you now start having swap lines as nothing but a substitute for official lending and somewhat permanent lending, as well as the point that Kathleen noted, and the swap lines like the Chinese, they were used for trade credit, but hey, we're going through a currency crisis. Why don't we use it for really be an exchange rate, which was very much not the intention of them in the first place. And then very quickly, as you see, it becomes a little bit of a mix of all of them. I think that mix, there's a little bit of a danger in it, because that mix then starts resembling a lot swap lines being used as effectively official lending across sovereigns in a way that competes with the IMF or complements the IMF, but creates an international financial network and architecture that starts being one that is more bilateral and less multilateral, and that I see with some concern in that regard. But just to say that, yes, the world may be evolving to that more confused one, and that more confused one. The US swap lines are crucial in the dollar-based world. The swap lines like the ones that I discussed in this paper are crucial for trade credit and development of trade. The exchange rate ones, not so crucial once you don't pay the exchange rates. But now we have these mixture of swap lines that are appearing, or change of contracts, that are more of an international financial lending, official lending. And those I see with more concern.
Great, wonderful research agenda. I look forward to the new paper. Thanks so much for being here. I think we have to wrap it up.
Thank you.
And thanks for the questions. Thanks for all of you listening, and we'll see each other after the summer, sometimes in September. All right, Ricardo, thanks a lot again.
Thank you very much for having me.
Have a great day and see you soon.